Yeah. So I have started it and okay.
I still can't turn on the video. It still says you cannot start your video because
Just
the
a second.
host.
Just a second. Just a second. Uh, Release videos. तुम एक चीज़ करो, जरा गूगल कर लो कि एक्टिवेशन अगर हमें एक्टिवेट करना हो इनका वीडियो. Okay, just a second. But there shouldn't be it. Because we had already done here for just a second.
So do I come on from the beginning, or do I only come on at
You,
5:30?
you do one thing. You just exit and again try to enter.
Okay, I'll do that.
Because we did it a couple of sessions, but and normally automatically the video starts. There has been you can do one thing. You can exit and maybe re-enter again. क्या होता है मतलब you do everything ना, but things are never perfect. Yeah. Allow panelists to start video.
Yeah, I just came
Allow
back
panelists
on.
to start video. Okay, now you can do that. I have just approved that. Okay, now try starting the video, please.
Okay.
Okay, great. How are you, sir?
Good.
Wow, it's really great to have you on board, sir.
Oh, thank you. Thanks for the invitation. No, I wanted to check with you. I saw I saw in the agenda that my segment is at 5:35. So
No, we just have given that as a tentative breakup, but this is now how it would be going because our first speaker, Mr. Bikram Sen, due to some exigency, he would be connecting us separately tomorrow. So automatically the schedule have come ahead. So what we will be doing, the normal protocol that we will be following would be, we start with the federation and the broader economics, macroeconomics. From there, we will start on different, you can say, asset classes, starting from the exchange, that is BSE and NSE, then trading houses or structures and all, and then there are alternative asset classes or global. So we have real estate like World Trade Center, and we have iFast Global for global portfolio. So as an investor moves from the normal asset class to the alternative assets, global investing, affluent investing, accordingly the trend of the panel will shift that way, because there will be gaps in terms of say, for example, we are talking with somebody who's investing in mutual funds and the mutual fund manager is talking about it, and then uske baad, if there is something disconnect, we know that there is a gap and Indian mutual funds cannot address that. So you will be taking that point and you will be mentioning that point into this, what we say that in your session.
Okay, right, got it. So
Yes, that is how.
Yeah, so I will be coming on live from 4 o'clock then.
Yes, you'll be live on 4 o'clock. We will be introducing you all. and our director general will be taking it up, and then accordingly we will take it up from there. We'll run the show. Okay, so by the time you can at least mute yourself, or you can blacken your screen, so that we can get all others also on board in the meantime.
Okay.
Say for next 20 minutes, within the next 20 minutes.
Okay, so we've tested that it works. So I'm just going to click off my video and sound.
Yes, yeah, and mute. You can just, yeah, you can mute, and
then I'll come back on in a few minutes.
Sure.
Okay, thanks.
We'll connect maybe at 3:55, maybe
Okay,
5 minutes to 4. We can do that.
Okay.
Thank you. Thank you. Thank you. Okay. So now we have to do one thing. We have to just call each and every. बहुत बढ़िया डाल दिया नहीं बहुत बढ़िया हाँ जी सर सर आपको लिंक आ गया होगा
अपडेट में आएगा
सर अपडेट में आएगा नहीं तो आप एक चीज करिए कर लीजिए जो मैंने आपको लिंक भेजा है ना व्हाट्सएप पे आप क्या करिए सिर्फ उस लिंक को क्लिक करिए ऊपर साइन इन लिखा है
व्हाट्सएप पे मत भेजना मेल पे भेजना
मेल पे मैं भी भेज रहा हूँ सर आप बस एक मिनट सर जस्ट अ सेकंड व्हाइल यू से दैट मैं आपको
डॉक्टर रवि सोटा भेज
हम
डॉक्टर सोटा
एक सेकंड सर डॉक्टर सोटा
SAUHTA@gmail.com
dr doctor SAUHTA@gmail.com ठीक है सर ठीक है सर डाल दिया सर मैंने ठीक है सर मैंने डाल दिया है आपको जस्ट अभी मेल आ रहा है और इसमें आपको करना कुछ नहीं होगा सर आपको क्या करना होगा आप यू विल बी जस्ट साइनिंग इन ऑन टू इट yes sir I'm just sending that
Hi Rajat.
Hello ma'am, how are you?
I'm good, you tell me how are you?
बिल्कुल fine man. Ma'am just give me a second yes hello sir. हाँ जी सर आपको क्या करना है आपको लिंक डालना है आप उसमें जो ईमेल आईडी डालेंगे आप डालेंगे DO वाली DO@IndianInvestor_Federation आप वो डाल दीजिए OTP अभी आपको शुभम बता देगा जस्ट होल्ड ऑन सर को लिंक मैंने वाला भिजवाया है माइक्रोसाइट का तो सर डालेंगे DO@IndianInvestor_Federation उससे जो लिंक आएगा ना OTP आएगा वो मैं आपको बता दूंगा वो आप सर को बता देगा एंड मैम हाउ हैड बीन द वीक
Oh, busy Rajat, and I'm on the road actually.
Okay.
I was supposed to have reached a place, a destination, but I am 2 hours away from there. So I thought that let me take a stopover. So I had to find, I'm on the road of Punjab, so I have to take the stopover at some restaurant.
Okay.
So that I could be with on the committed time.
Thank you so much ma'am. And we also have ma'am Mr. Vineet Bhatnagar, managing director at Phillip Capital, who has just joined us. And sir, she's Miss Caroline Sasha, has been the president for World Trade Center Services here. So
hi, good afternoon, Caroline Sasha.
Call me Kat, that's easier, otherwise
Okay,
it's a
I think that's
mouthful.
much easier. Yeah, and call me Vineet.
Hi Vineet.
Where are you? Which part of the country are you in?
I'm in Chandigarh. I'm in Punjab right now on the road on way to Batinda.
Oh,
So
wow.
I took a stopover because I had to find a place. Otherwise, I would be on the road
I know
or in
that.
the car.
Good. You're lucky that you have got a good
Somehow
connection.
I miscalculated the time. No, there was a miscalculation of time. So I thought, so I had to stop over wherever I could find a good, decent restaurant.
No problem. I think you are lucky that you have got a good connection.
बात करो जरा Gmail के
It's a hotspot from the phone, from the mobile.
Okay.
Yeah.
Okay,
So
good.
the technology now, we're more technology savvy.
Yes. Very good.
Thanks to pandemic, that's what we've become, if nothing else.
Absolutely. You have
So
all learned.
where are you?
I'm based in Mumbai.
Okay. Absolutely. I should have guessed that, considering capital investments. That's our financial capital.
Yes, very much so.
So how are the investments post-COVID?
I don't know whether I should call it post-COVID or the COVID is still going on because the numbers have started rising. But nevertheless,
Yeah.
from October, November onwards, it has been quite, quite good because, things were under control and the company started showing better profitability. So the prices started coming back in terms of the stock prices. So now people have made decent money in the last 6-9 months.
Yes. I mean,
Hmm.
there has been a positivity, especially after the news of the vaccine. We
Yes,
did see that, the sentiments were nice. Everybody wanted to get out of that COVID mode.
abs-
And so uh, just needed the right sentiment. And the vaccine was probably an excellent sentiment.
I agree. I agree.
Um, Now with the numbers again rising and fear of another lockdown, so probably again we might see a slight dip. But then I think we've also realized that we're quite resilient.
Yes, absolutely. I think that is exactly the point that you have found correctly. That people have greater confidence now that we will be able to manage the crisis. So the experience is obviously with us. Medical knowledge is with us, and people are more confident that even if there is a second wave or a short period of rise in numbers, we should be all okay. I guess as long as we
Yeah,
don't become completely irresponsible, it's all doable now.
yes. I mean, we need to be alert, not complacent, but
Yes,
that is what we are actually observing. Even the investments which we are seeing in
right,
WTC or which we are seeing in the industry, we're seeing the same sentiment actually occurs.
right, right. So have you been working all these months? I mean, remotely or
Most till October, it has been work from home,
okay,
completely work from home. October onwards, it's been a hybrid,
okay,
but January onwards, it's a complete work from office.
okay, yeah,
So gradually, we have been moving, and I believe that now we're again going to be opting for a hybrid way of, not if we are sensing that we are down with cold or anything,
yes,
we are all taking necessary precautions and staying back home, quarantining ourselves, staying in isolation, not
yes,
risking anybody. So
yes,
it's a hybrid,
right.
right now that we. But I've started traveling now once again.
Right.
आपका पेज पे साइन चाहिए और सर स्टैम्प चाहिए लास्ट पेज पे आप स्टेप लगा देना चाहिए.
So hi, we have Dr. Ravi Sauta, who has been the director and HOD at earlier with the Max and now with Artemis Hospitals, and he's one of the panelists who is actually, you can say, putting forth the issues from the investor community, which we talk about the medical fraternity.
Right.
So if we talk about the investors per se, we have normally three different categories of investors. We have those who are affluent investors between 35 to 40 years of age, 50 years of age, but are from the technology background or consulting background. Then there are defense personnel, and then there are those who are from the medical field.
Right.
So since in it as an investors Indian Investors Federation body, we always yes, and we also have Mr. Meng here with us from IFAST. So just getting on to the point, so he will be actually putting forth the issues that are actually being faced by investor community and medical fraternity at large.
Right.
So we have made a point that whenever we enter into any roundtable or any discussion, because it is an Indian Investors Federation, there has to be one representative from such investing community, so that those words are put forth. And if they have any queries, they can directly ask. So we have Mr. Mohan Ming from the iFast Financial, and he is actually the founder at iFast Corporation. He has been the co-founder. and they are one of the largest mutual fund platforms in Asia, headquartered at Singapore.
Right.
So, welcome, sir.
So exciting.
Hi, hi. Good evening, everyone.
Good
Good to meet
evening.
all of you.
Hi.
Hi.
Good to have you with us today.
Gmail पे भेजा link.
Thank you. Thank you.
2 minutes रही हूँ मैं आपसे।
So it's Saturday evening for you.
So
in
we
Singapore.
have on mute Carol.
Yes, it's
We
about
have then
6,
Rajiv.
6:20 here in Singapore.
Right. Singapore has actually managed to contain the entire pandemic very, very well over the last so many months, right?
Yes. And yeah, sorry. The audio is a little bit intermittent. Sorry. Did you say something?
No, I was just saying that Singapore has managed to handle the pandemic very well, because of the way the policies and the SOP were announced. I thought that Singapore did a good job of.
Oh, yes. I mean, yeah, we're a small country and we're an island. It's easy to close off everything, and the Singaporean men. We all have to serve 2 years in the army, so we're very good at taking orders. You tell us to wear a mask, and we'll just do it without question.
Yes.
So it's been quite easy for the government to implement all their plans. I think everybody in the country has been very cooperative. So yeah, I think it's been. I think that there are very few infections. In fact, and when there are, it's usually people who like work at the airports or in the hospitals or at the seaport. So there's always a very strong reason why they got the infection. So it hasn't spread in the community. So we're quite thankful for that.
Yes.
And
So-
I see that the infections in India are coming down very dramatically. Oh, sorry, Raja, are you about
No,
to
sir,
start?
please complete your sentence.
No, we're just talking about. I was just saying that the infection numbers in India are coming down very dramatically.
Yes, as a country, yes. Although some pockets, have started seeing some, minor increase in the last 3 weeks. But overall, I think as a country, there is a tremendous, improvement from December onwards.
Right. Wow, it's amazing.
So I will be just, we have 2 new joinees here. One is Mr. Rajiv Garg. He's the regional head with Bombay Stock Exchange, and we are very thankful to them that in a very short notice that Bombay Stock BSE actually were able to scout out the time, and we got him on the panel. And that too, when obviously that NSE fiasco has actually got many of us bored. Investors got bored onto the pitch, rather than, I would say, not hit wicket, but clean bowled. So having BSE on board is quite comforting and very important that we have got him on board. We welcome Mr. Rajiv Garg.
Thank you, sir. Thank you. Hello to all.
And and हमारे साथ जी, yeah. And we do also have Mr. Dilip Sharma, who is the Director General with Indian Investors Federation, and this has been his idea, having such a meet and having such an august gathering from all the stakeholders from end to end of the business community. He has been the director at ASSOCHAM and is currently the presiding Secretary General with Punjab Chamber of Commerce and Industry. So we still have Miss Lakshmi Iyer pending joining in. She'll be joining anytime soon, maybe in next 2 or 3 minutes. So Dilip ji, thoda sa you can start interacting. We have Ms. Carolina Shah from World Trade Center, Mr. Bhatnagar from Managing Director Philip Capital, Mohan Ming from iFast Global, Dr. Ravi Sauta, ex-director at Max Hospital, the current director at Artemis, representing his point of view from as a medical professional and a tuned and high net worth individual investor. and obviously the Rajesh Garg, whom you know quite well. So we still have 10 minutes, so we can have a ball for me together.
I said good afternoon to everyone, and it's nice to have an opportunity to get to meet such people from the financial world, because if you talk from the finance sides, we have a lot to learn from you people, because you are the experts and you have the in-depth knowledge of the field. But my background, you look at me, I've been more involved in the chamber for last 15 years, and before that I worked in the industry. And we know that it is the money which makes the world go around it, and everything is about the investments and the investors. And that's wherein the idea came in, okay, let's do something related to investors, protecting their interest, taking it forward. So that was the idea we worked on for last 6 months in terms of having such platform wherein we work with the investors on the policy advocacy, then we talk on the grievance handling, and then third is the opportunity creation. That's the thought we had for this platform when we went ahead. As I said, Rajiv, I've known from the PhD days. We did a couple of programs when he was along with Mr. Soki, and rest of you I'm meeting for the first time, and I'm hopeful that the first meeting will go a long way. We'll have opportunities to meet and work together in times to come.
Yes, why not? So, Mr. Sharma, who will be the audience? Are these the members of IIF, or have you invited other members?
So this is the stakeholders. When you're talking about stakeholders, they are the investors, industry association, industrial policy makers, and the fund managers. So it is a mix of all these stakeholders here coming as part of the audience.
Okay.
And also what we are doing as we have got, because we do not want to because we wanted to very better controlled environment for this. What we did while we initiated the meeting on the Zoom, and also it is also being it would once we start off, and it will just be broadcasted live on the Facebook also, so that the general public who actually, because normally what has happened that too much of familiarity breeds contempt. So people are doing so much of the Zoom meetings today. So even if we get a normal viewer onto the Zoom, it's a hassle. So we are broadcasting it live also on the Facebook as we hit it. I will just checking up on Miss Lakshmi Iyer, and we have, I believe, still 5 minutes to go, and accordingly we can do that. I'm just muting myself. Hello, Miss Iyer.
Hi, Rajat. How are you?
I'm absolutely fine, ma'am. How are you doing?
All good. Sorry, my previous call stretched a little bit longer. I don't know whether it's Monday or Saturday. I don't think it's making any difference to our lives now.
Nee, you know what? It said that money doesn't set on the British Empire, I believe, but together we show me the money. We are in the business of money, so money never sleeps. So
I don't.
Neither do us.
No, I don't need to be shown the money because my name itself has money. So that's the problem. I have a life problem. So I have to figure it out. And we are all doing Zoom barabars every day, and the Zoom sessions just don't seem to be ending.
Very nice. And to all the others who have been there, a couple of you would actually be knowing her. She is Miss Lakshmi Iyer. She is CIO, Chief Investment Officer for Kotak Mutual Fund. And for Kotak Mutual Fund, she specializes in fixed income and debt. So let me do one thing. I would be just setting it on the broadcast, and just give me a second. We will be going live on Facebook. Just a second. We'll be setting on to the. Okay. Okay, this is this. Share it to the. We will go on to the Indian Investor Federation. No, we'll go to. Okay. Okay. This is this. This is this. It's just streaming. It's just buffering. It's just buffering and streaming it up. Okay. Just give me a moment. It's just loading. Next. Done. Title. Post. COVID. Strategies. Discussion. Okay, we are done. We are going live on Facebook now. 1, 2, and 3. It is just setting up. Okay. It is just redirecting to the Facebook page now. शुभम जो लिंक आएगा ना फेसबुक पे गया है हमारे कंपनी के ask the marketing team to flash it out across every channel and everywhere. Yeah, Viva is just getting loaded. It's on the final level. It has been processed. It's just getting posted. Okay. So now we are live on Facebook. Okay. So coming back. Hello everyone, and I, Rajat from Indian Investors Federation, Director Investments, hereby welcome the August gathering of attendees here. And right from the point of beginning, I will first state an objective so that our viewers actually understand what is the notion of this and why these set of panelists have been brought onto the panel and not the other one. And thirdly, what you could expect out of this. So just as a brief up of it, it is an Indian Investors Federation. It is a non-profit body that actually take care of the investor needs, their interests, and we take that forward with the regulatory bodies, government agencies through policy framework, advisory, advocacy, so on and so forth. So under that objective, we have got an August gathering of this people who are representing different stakeholders or stakeholding companies, ranging from mutual funds, stock trading companies, stock exchange, real estate, global assets, so on and so forth. So let me first introduce with the panel here as I may introduce each and everyone. So firstly, I would like to introduce, I will ask Mr. Dilip Sharma to first say a couple of words about the Federation and what we try and intend to bring in. And from there, I will bring on to each panelist. Over to you, Mr. Dilip Sharma.
Good evening, everyone. To the eminent panelists who have been thankful for sparing the time at such a short span. And to all the people who are attending the program today, and even some people who are watching live at different channels. The objective of Indian Investor Federation is to engage, enable, and empower the investors. So we work on 3 fronts. We work on policy with the government and the regulatory bodies as far as the interest of the investors are concerned. We work on the grievance handling of the investors with the respective investment bodies. And third is then we work on creating the opportunities for the investors. I mean, how do you define Indian investors? Indian investors for us is any person of Indian origin investing anywhere in the world. Second is anyone making investment into India is also an Indian investor for us. So all the investments by the Indian within India, all the investments by the Indians outside India, and all the investors outside India investing into India is our stakeholders for whose interest we are representing. And it is going to have 2 verticals. One is going to be B2C, which is the more focus on retail, which talks of the stock markets, mutual funds, insurance, real estate sector. Second is the B2B, which focus on the project funding, industry, which will be sector specific, area specific, and country specific. We will be engaging with Invest India, state investment boards, and respective all regulatory bodies in the country for the interest and opportunities for the investors in time to come in. I think so. This program is more for the to learn from these speakers. We could talk of the Investors Federation in times to come again, and I feel that we should give more time to the panelists, and the audience are there to listen to them and less listen to us. So I'm thankful to everyone, and let's take it forward from there.
Thank you, Mr. Sharma. And I will first introduce the panelists from the financial world here and why we have brought all to them. Uh, so in an investment landscape, if I have 100 rupee and it gets invested across many asset classes, a larger chunk of it goes into the real estate and much of it also goes into the stock trading. What COVID times have done it, and it has been a game changer for many of the brokering houses where the people actually who had never ventured into the stock market have entered into it. COVID had been testing time. Much of it has been now behind us, and people have lost money also. They have gained money also. There are many emotional biases to it. So let me first, how to handle that, what is a broader landscape, how each stakeholder can be a value creator for an investor, and what issues investor face and how they can be mitigated. We will be asking that. Now, first I will introduce, and at the end, I will also be taking up with Dr. Ravi Sauta, who will start putting his queries and then take forward. So for the general public, we have, after Dilip Sharma, I will just, the way financial system is structured, we will go from top to bottom. So from the regulators or the federation, then we are going to the stock exchanges of platform. So we have Mr. Rajiv Garg, who is from BSC Investors Protection Fund. So you may say he's associated with the platform Bombay Stock Exchange, or you can say the BSC, which is now it is rechristened as. So he's a regional head there. He will be, we would be actually putting our pointers with regard to the exchanges and how it would actually be to the benefit of the investors. So he has joined us from the exchange platform. After that, we have Mr. Vineet Bhatnagar, who is the managing director and CEO of Flip Capital India Private Limited and for the UAE business. The Flip Capital is one of the leading trading houses of Asian market, and it has been one of the largest players, if I would say, of the Southeast Asia and Asia, if I'm not wrong. Mr. Bhatnagar, welcome on board, sir.
Thank you, Rajat. Nice to meet you.
Thank you, sir. Thank you, sir. Thank you, sir. Now, coming on to the next level from now, we have seen that BSC and we have seen the trading house. Now from the mutual fund space, we are lucky to have Miss Lakshmi Iyer, who is the CIO, Chief Investment Officer from Kotak Mutual Fund, or we can say the Kotak Mahindra Asset Management Company, and she is specialized in fixed income and debt instruments. So guys, if you were fixed deposits are making you lose money and pay more taxes, she's the lady you might be asking each and every question that hits your mind as far as the fixed return कि कितना मिलेगा या ये हमारा ये फंड कितना देती है, तो वो आपको ये मैडम ही बताएंगे कि yield कितना मिलती है. She is the best player onto the market. Not even many of the distributors will be able to answer you in the current market scenario. So coming on to next, from now we do have alternative asset class. हम alternative asset class को we are now taking it in a different parlance altogether, but we are already invested into it, which is called as a real estate. Even if in affluent or an HNI segment, I would say if a client is having a 1 or 2 crore of investments, he would be actually having a 4 crore of the real estate assets. But how are they managed? What is the changing trend into the real estate market currently, and what the international players are bringing in, and what challenges are there in the real estate area? So we are very proud to invite and have her here, Ms. Khairul Nisa Shah, World Trade Center presiding president for WTC services, and also chairperson, and you can say the presiding executive director representing India in World Trade Center US body, if I'm not wrong. Correct me, ma'am.
Thank you so much, Rajat. Thank you.
So you can say from the female fraternity, we have got 2 strong ladies here, and we are very proud to have you, both of you, on board, ma'am.
We are proud to be here too.
Thank you. Now, from these asset classes, we have Mr. Mohong Ming, who is a co-founder of the IFAS platform. So IFAS platform is actually a fintech. Many of you investors are very much gung-ho about the fintech revolution that is coming in India, but you might not be aware this revolution had way back started in Singapore. And IFAS, if I'm not wrong, Mr. Meng, you can correct me, they have been pioneers in it. They have done a web, and many big institutions use their platform for mutual fund transactions. It is headquartered in Singapore. They have a growing business in India also, and how the fintech space is changing, and what Indian investors, for the benefit of the Indian investors, what options such platforms bring on to them, and how they can optimize their returns and de-risk their Indian portfolio. I think he's the best man on that board. So welcome, Mr. Hon Meng.
Hello, everyone. Thank you for inviting me.
Great stuff. And now, as an Indian Investor Federation, we always have one panelist with us who is from the investor domain. So we are very proud and we are very happy and delighted that Dr. Ravi Sauta had acceded to our request and amid his tight schedule be present here and also interact with such august gathering. So he's a director and HOD for orthopedics division in Artemis, has been associated with many leading hospitals like Paras and what do you say that Max Hospital. And in a simple parlance, if I may say, he's an affluent investor who has his own ups and downs, his own experiences, has his own questions that had already been hitting him hard, and he and I was obviously on the receiving end, always getting my head banged onto the wall. So I thought, why should I have all the fun? So that thing, I thought this is our gathering. We have an investor who has an experience across much of the asset classes, who is aware of the dynamics of it, actually put forth his queries and give start to this session. So off to Dr. Sauta. Sir, welcome on board, and I would like you to have your queries and what are your queries and your point of view. Thank you.
Thank you, Rajat, for giving me this opportunity, and thank you for inviting me on this India Investors Federation. So, as pointed out by Rajat, that with Rajat we have a very long association. It goes around more than a decade. But the fact remains that I have been always very conservative and very, very reserved investor for that matter. Reasons are very much because I belong to a medical fraternity, medical profession. We have same needs as the others have in the profession. But the fact remains that we are, at least I am very poor with the numbers and very, very far away from the word so-called investments. And we do lack time, we do lack the interest in the finances, and we have a very poor fund of knowledge as far as the investment and their returns and safe investments are concerned. Most of the professionals, I still believe that they are definitely very conservative in their investments. So they are one, they are busy in the work, and other they are their financial planning is very poor because we don't actually learn it anywhere throughout our training. So thank you very much for this panel. So it helps answer a few queries which are bubbling in my mind. I know that doctors still who do not invest, and if the panel would suggest that the doctors who could start investing, if there are certain golden principles which could be helping us to understand. Second question of mine is that because of the time constraint and very busy life with the professionals, as we see, because especially when I look at my life, we attend to the emergencies at all hours and busy and this that. So is there any portfolio structured like which can work at auto mode? So I would like to know from people on this component also. Another thing also, is there an optimal debt portfolio which can be structured for the doctors who are very conservative? So how can that be structured very effectively? And also, I have a little query regarding the Bitcoins. If the government comes up with their own digital currency, what happens to the Bitcoins, and what happens to the money lying out there? Also, very recently, we have seen that the GLIT bonds, or so-called government sec bonds, have been now opened up for the individual investments. Till now, they were primarily available for the institutional investments. So I would want to know how really to handle the volatility, and how long should we hold on it, if somebody can tell me on the panel. Very august people are there. Another thing also I want to know if any of you can tell us 3 mantras invest from how to that would actually be very helpful for the investors' point of view. And thank you very much for the opportunity. As I said earlier, that I'm only going to be question master, not having any answers for this panel. Thank you very much for giving me the opportunity. Rajat, over to you.
Thank you. Yeah, thank you so much, sir. Thank you so much, sir. And sir, even I am very much delighted. It is the only place I can pose my questions because घर में तो मैं भी नहीं बोल पाता हूँ. So, so it is the best place I could be. And normally I do spend my weekends like that. So thank you for your queries, and I have noted your queries. So as we proceed, I will be taking your queries on and off, apart from many questions that we have also received from the general public. So therefore, on this, I would like to now invite from, you can say, the BSc. From the BSc, I would like to invite Mr. Garg on to the panel, and I will start his queries here, because how we would follow is from the exchange to the platforms, to the funds, to the alternative investments. That is how we could go. And if I have missed some points, or when you invariably also wish to present something, we will be very happy to have it. So, Mr. Garg, first and foremost, like we have seen just this week, NSE platform, and we had been actually bombarded when the people came to know that, okay, there is a BSE here. So although there were limitations in terms of the identities they could have, so they have posted one question. The case that has happened with the NSE, with the infrastructure getting crashed while the BSE was functioning, although clearing there had been some issues, but there are two, three basic questions. First and foremost, are the backend network providers for BSE and NSE separate, or are they same corporate entities? Say, suppose you're using Airtel infrastructure or a Reliance infrastructure. What has been the case? What actually has transpired?
Thank you, Mr. Rajat. As far as this NSE case is concerned, still investigations are on. Both the exchanges have state-of-art, robust technology and infrastructure. Technology can have glitch anytime, anywhere. Anyone can face that. As far as these backup vendors are concerned, broadly they are same. We all have 4, 5, 6 vendors: Airtel, Reliance, Tata, 3, 4, 5 vendors. Both the exchanges, I believe, have all the vendors and all the multiple links that could have issues. Still, investigation is on, and the question was raised: why their DR site also not backed up and not working. Still, that investigation is on, but obviously it's a bigger headache for everyone, and it's pained everyone, and it's raised the eyebrow for everyone to go for more robust infrastructure, more backups, maybe 2, 3 DR sites. Actually, it can be seen only by the technology person once the report come after this grassroots analysis, what exactly happened, and SEBI is looking into the matter, and things will come shortly forward, what exactly gone wrong.
Okay, so when this actually happened, what we did was that we went back to normal, that demat trading terms and conditions are there. Correct me if I'm wrong. So we have seen that if market crashes, or you can say the platform crashes due to technology issues or internet connectivity or such service providers, in that case, obviously the liability does not remain with the exchange or the trading house or so on and so forth. And the loss is completely the investor's loss. Now, my point is, when because we know that quite recently, over last 2 to 3 years, to protect investors' interest, there has been an investor protection fund that has been created. So now, since this is a scenario which has happened for the first time, at least I can see it happening for the first time in last 5 years, or say half a decade. So now, is there any rule, or you can say, if such a situation arises, is there anything in their regulations that say that, okay, if there is a technical glitch and the investor's money has been lost, so investor protection fund can be utilized to compensate the investors? Is there any rule for that?
No, not as of now. Not as of now, but SEBI is thinking on that line, and SEBI very recently has issued a statement. They are working on this. They may go for this, but it's very complicated area, not easy to work out who has lost, what they have lost, how they lost, what kind of technical glitches at the exchange and broker and system end, and whether it's an actual loss, it's a notional loss, it's a probable profit. It's a very, very deep discussion area, and one cannot be left with the unlimited liability stuff. It's very difficult.
Exactly. But, so that
yes, shortly things may come, because these kind of things are happening frequently, not at exchanges, even at brokers, even at the vendor, software vendor, front-end vendors, back-end vendors. Yes, some liability or some accountability has to be fixed in some way.
But at least
As
I'm
of
very,
now,
I'm quite happy.
Fund is not meant for this.
Yeah. Okay. At least I'm happy that when you, as a person who has been working with exchange and all, and for so many years, for so many decades, at least because this has happened for the first time in the recent past, and at least that thinking has started. Okay, we are
Yes.
now exploring the ways how we can compensate the class. Obviously, when there can be a lack of crore of a loss happening due to the technology glitches, obviously that entirety cannot be compensated because somebody has to foot the bill. And Indian investor protection fund obviously has certain limitations because it hands are also tied and also spread to the different asset classes, so on and so forth. But we actually it is a welcome move that the discussion has started on this parlance,
But this
and one
kind
more,
of technical
yeah.
glitch, luckily, have this time, first time during this crisis, it has interoperability between both the exchanges, first time. So it bailed out many investors, although all couldn't take that benefit because there was issue at NCL also, this NCL Clearing Corporation of NSE also. So majority of the member couldn't trade at BSE even those that day, but many of them were able to trade. Imagine the day if we don't have the interoperability and it was one day before expiry, the damage could be much more worse.
Great. So I think that has actually had been quite phenomenal and had been a saver for many investors, had not been that
Yes.
that knell that otherwise could have been. Thanks so much. And now one more point. Like we know that there was a vision for Indian government, like international exchanges, like we have an international exchange based out of Singapore or Hong Kong or London. Similarly, in Gift City, Gujarat International Finance Tech City, BSE had set up its terminal, which actually, if you say, and I'm very happy to say that World Trade Center actually is having a presence in the Gift City. So actually, I would say I'm very happy to say that we two panelists from the two different verticals are in the same jurisdiction, which actually is a foreign, it's a foreign territory within India, which actually provides as an international exchange. And Gift City obviously is now getting occupied quite soon because it is already on way. So in Gift City, we know that there is a limitation that only retail investors can also invest into it, but those whose investments are $1 million and above. And quite recently, जो different stock trading houses थे, उनके भी वहाँ पे, they also started opening their offices over there. So how do you see, can a retail investor who is not having say $1 million but lesser than it, say $500,000, can he optimize his chances, or can he try his would he be allowed to take investments into the Gift City International Exchange for trading?
No, sir, not as of now, because this RBI has allowed this only LRS scheme, which says the net worth of individual is more than $1 million, they can go for investment abroad. They are already under LRS liberalized remittance scheme, and same has been permitted for Gift City. Although for NRIs and the other ultra net worth individuals staying abroad can invest up to any extent, but for the resident Indian retail investor, it is not meant for that. As of now, tomorrow government may take liberalized view, but for that country has to go for the fully rupee convertibility. So that's a policy matter with the RBI. But a lot of other things are coming in the INX Gift City. Foreign companies, Gift City we may say still is a kind of a work in progress. Many things are coming. Foreign companies listing may be allowed. It is in pipeline with Ministry of Finance regulation on that. And very recently in this November 20 during lockdown, this independent regulator has been set up in the Gift City, so which will coordinate all the sectoral regulators like IRDA, SEBI, RBI. So independent regulator has been set up, and many InvIT and REVIT investments are also allowed. Many product mix are allowed. Only equity has been left. Direct equity buying and selling is not there. Hopefully it will come. Depositories are also setting up, and this gold spot exchange is also coming up. So government is very clear on their vision, although it may take some time because it's sort of work in progress, but things are moving fast. So it will be definitely on the line of this kind of Singapore, Dubai, London financial market, maybe in 5 years or 10 years from here.
Great. So that means even if there's any investor who has that amount of the corpus plus of $1 million, so he can very well go on for it. And I believe, if I'm not wrong, Philip Capital also has their unit set up, their trading house set up there in the Gift City. Okay. So thank you. So as I would like to say here that uh, there has been one peak margin policy that had come around in the month of November,
Yes.
December. How
Yes.
that peak margin facility actually impacted BSE, and whether it was in interest of the investors or it was a detrimental. So what was the objective for it, and how it actually impacted when it was enforced. So peak margin facility, when it was enforced, the notion it with a certain objective it would have been enforced. Now, when it was enforced, what impact it had on the turnover or the business for the stock exchange, and how it impacted clients, whether it was a difficult thing they did for it, yeah, how it transpired, yeah.
No, sir, it is very good thing they did for the long term because there was too much over leveraging was going on in the market that was compromising the all risk management system at broker end, client end, and even at exchanges end. There are a lot of brokers have defaulted in last 2-3 years. A lot of over leveraging were happy, and it had impacted volume little bit for 2-3 weeks, but now everything is back to normal. It is a short term pain for 2-3 weeks. Now volumes are same as before this peak level margin, and I don't think, and it is in the safety of long-term market and to ensure the risk management in a better way.
Okay, great. And we have actually now people started raising hands for it. So I would request you guys to please wait till the end of the session, because there will be a separately dedicated question and answer session. Or you can also put your questions into the chat and we can be taking it up with your name. And we may also allow you to join into the Q&A session as it happens, because people are now started asking it. Yeah. So lastly, with your session being wrapped up, like Dr. Ravi Sauta said, now, Dr. Sauta is always too an intelligent guy. He knows that he has all these 6 panelists here, and he has said, I need 3 golden rules. And when you have 6 people on the board, 6 3s are 18. So he's having his whole pocket filled up with all the golden rules. So he will be having, say, 18 golden rules. So I would request you to have your 3 golden rules, which would act as a compass for the investors. And what would you like to say, seeing this COVID scenario? With 5-year vision, what is a strategic insight that you would like to share, or 3 learnings that could be an insightful for an investor?
Sir, for investor, it is only investment. From exchange point of view, we only encourage investment and long-term investment, and medium to long-term investment. We discourage the trading, speculation, that kind of stuff, because it's a specialized job. That is a specialized job, could be done by the specialized traders having the infrastructure technology in place. For a routine investor or the person like Dr. Saab, it's not possible to have spare time for this day-to-day trading. It's not good. Either they should hire some specialist or go for investment. Plain investment, long-term investment, and a mutual fund and ETFs are the best way for the going forward to have long-term investment. Because if we believe the India growth story, so investment should be long-term, and the mutual fund and the ETFs are the best way to enter into market.
Great. Thank you so much. Thank you so much, Mr. Garg, for your kind views, and also like elevating the fears of those who had been hit by the NSE scam. And we are very happy that the exchange and the SEBI has actually now started thinking about the compensating the clients, at least creating some fund for it. Although the process is going on, so it's good that the thought has been started in that balance. Now, next, going on to this, we will move one step now ahead. From the exchange, now we are going on to the trading house or the broking. And we have Mr. Vineet Bhatnagar, Managing Director from Phillip Capital, joining us. So just a second, we have, okay. Hello, sir.
Hi, Rajat.
Okay, great, sir, great, sir. And I believe in the Gift City, also Phillip Capital has initiated its interest of operations, if I'm not wrong, sir.
That's right. We do have a Gift City entity, which is already a member of INX and the National Stock Exchange entity. So we are already participating on both the exchanges.
Great, sir, great. So, sir, like we know that like Phillip Capital is just like Carvey, or you can say the Angel Broking, HDFC Securities, so on and so forth. And from the investors' parlance, I would like to start it from a point which around 90% of the investors actually are not aware of. And post-COVID, let me set a tone for it. If I'm not wrong, I've come to know that Phillip Capital has been one of the largest players in the SLBS segment, securities lending and borrowing. And believe you me, in our experience with Phillip Capital over the last 5 years, what we have done, we have explored that bit. And we also came to know that many of the people were not aware of it. Now, seeing the COVID scenario, now there are the two type of things. Like, we want to invest, and seeing the market going high, we are jumping onto the things. Now, there are a set of investors who have their holdings, who do not want to trade or have their holdings in a loss. So they do not want to book the loss. So how does SLBS, if I may say, would be a benefit to them?
So as the name indicates, Rajat, SLBM is essentially securities lending and borrowing market segment, right? In many countries, securities lending and borrowing is an OTC market. But in India, most of such activities and products have been introduced on the exchange platform. So SLBM was also launched on both the BSE and the NSE platform many years ago, but it obviously had a very slow start because of the way the product is structured. I think a lot of education had to be done. People had to understand what is the purpose of it. And also, we have a very thriving single stock futures market. So when is it that people want to use SLBM? So those who own securities are obviously the lenders, and those who do not own securities want to sell it, and therefore they borrow it and sell it, right? So in markets where the single stock future, which is an ideal instrument if it is a liquid counter to take a short position, because you are looking at a decline in the price, SLBM is a very active market. But in India, because SSFs came far before SLBM came, it became a more vibrant market. Indians do like to take calls on the long side or short side of the securities. So SSFs have been a part of our market for the last 15 years, right? But the point that you made is very relevant, that there are a set of customers, whether they are HNIs or they are institutions, who always have a holding portfolio. And that is a portfolio that they do not want to sell for whatever reason, because they think that these are their long-term holdings, or this is not the time to sell, whether it is making profit or not making profit. This would mean it could be HNIs, or it could be even mutual funds or insurance companies. For a while, the institutions were not allowed by their, by their mandate or by their trustees to participate in this segment. But in the last couple of years, mutual funds, insurance companies, and HNIs have obviously all started participating. We have always been a part of this particular market segment because our customer audience is primarily HNIs or institutions. We are not so much of a retail broker as many of the other names that you took, because we do not have the distribution network like the others have, right? So from that perspective, it made a lot of sense for us to keep talking about it. And because we do business with both HNIs and institutions, we actually have both sides of the market almost naturally. So we have institutions who are natural lenders, and we have HNIs who could be the natural borrowers. Of course, HNIs can also be lenders, but we do have, and we do see that we have both sides of the markets when we talk to our clients.
Okay, great. Now, I will like to, for the public who are here and maybe still sounding these things Greek to them, और अगर मैं आपको काफी सीधे स्पष्ट शब्दों में बता दूं how it happens. Say, for example, if there is a stock, there is one stock, say, of $100, and there is a lending requirement or borrowing requirement come for around, say, 10 rupees. So that means 10%, 10 rupees of 100 is the 10%. So you can lend it for 10 days, and that 10 rupee per share will come to you. Even if you are having 1,000 shares, 10,000 rupees will come to you without selling the shares. So you are not selling it. Capital gains on selling or those things, transactional costs are not there. There's only the capital gains on the returns that you make. So apart from having a stock, the dividend, bonus, splits, capital appreciation, everything that comes natural to your stock holdings, free का आपको आप समझ लीजिए, you are putting you are putting your stocks on rent, and the cycle for rent is tentatively 20 days or 25 days. It closes on the first of the month. So आप ये पकड़ लीजिए, आपके पास if you have a 50 stocks of say 10 lakhs each, you can still have a 15-20,000 of say in 45-50 days of extra income just coming by lending the shares. Now, one critical question that I would like to have it. Now, this is something we are not taking any undue risk. There is no speculation. We are not judgmenting about the market. We are not judgmenting how the market goes. We have a stock. There is a requirement come. We already know this. Okay, we are getting say $10 or $100 out of it. We have lended. Now, one crucial question, and this was actually come to us by one of the investors we're discussing with him. He said, ki, okay, if we are lending it, if we have lent the shares, if an investor has lent the share for 20 days, now if somebody has borrowed it for the further sell-off, what happens if he becomes bankrupt? We know that these shares are under a lien. वो lien पे होते हैं, they have been put like this. And then when the maturity comes after 20 days, they are again pulled back and put into the demat account. So is there any case of a default which happens at the borrower end, or who is the settler? How it happens, say for example?
So the two important things that that we should keep in mind, and this is what has taken time for people to understand or get educated about. One, this entire product is on the exchange platform and therefore the clearing corporation. So the counterparty with which either the lender or the borrower are interacting, although through a broker, is actually the clearing corporation, because they are the ones who are ensuring the smooth settlement. Number two, the borrower who is looking to borrow does not have shares, that particular share, but he needs to have money, right? So what is important is that he may not have the share that he requires, but he needs to have 125 rupees for him to be eligible to borrow. So one thing that the product has ensured is that you cannot actually make a hopeful kind of a thing that आज borrow कर लिया, बेच देता हूँ, जब नीचे जाएगा तो खरीद लूंगा, उसके बाद उसको return कर दूंगा lender के पर. It is not structured like that. You need to show the money. You need to show, and that becomes the upfront margin that the broker is going to charge. And any default that is going to happen or could happen is so penalizing that it is not even as bad as the auction market. It is worse than the auction market, right? Okay. So there is the closeout is at a price wherever the price is. So auction ka jaise hota hai 10%, 25%, it is not limited to that, which is the reason why insurance companies and mutual funds, which are institutions and they handle other people's money, have come out and started lending. If there was, if the structure or the design of the product had these kind of loopholes or did not have, the confidence of institutions, they would not have come forward at all.
Okay, great. And lastly, from the investor perspective, and you are from the trading house, let me see. Normally, what happens? Ki Indian investors or Indian public, as such, goes on. Ki bhai, we have got vegetables and we are getting dhania, or we are getting a couple of things free of it. So now the trend started with many of the big discount brokers. And while the big discount brokers have come into the retail space, how do you see it is a what are the actual plus and minuses, or what are the things that could be play in favor? Yes, and what an investor has to keep in mind before jumping out to the free for all sort of offerings. So what an investor should think while he falls to any of those things?
No, so let us all understand that discount brokers are regulated entities. Right, so discount brokers have not popped up all over the country just by their whims and fancies. So all capital requirements, all regulatory compliances apply as much to a discount broker as it would to all or any other traditional broker. So the investor should understand they should not feel scared of going to a discount broker. But what is it that the discount broker has available for you? By definition, discount brokers are only providing access to the market, which means all the decisions that you are expected to take for your trading account needs to be taken by you, right? So it therefore depends upon the sophistication and the financial literacy of the trader to only have the platform which will give them an access. Now, over a period of time, discount brokers will also start adding what we call as full service bells and whistles, right? So they may have some kind of advisory, they may have some portfolios, they may have some thematic portfolios. You would go and see it on the platforms of those discount brokers, and that may be a fee-based service that they may be offering. It could be linked to the AUM. It could be linked to a subscription, which could be a monthly thing. And that is where the investors can get some knowledge, some ideas, some advice, and they can then continue to use that platform to do what we call as do it yourself, DIY type of trading, right?
Great.
It is therefore important for traders to understand what comes in that package. If their approach is that मैं टिप इससे ले लूंगा, मैं न्यूज़ यहाँ से पढ़ लूंगा, मैं ये रिसर्च रिपोर्ट करके ट्रेड कर लूंगा, you are responsible for your own money. You are responsible for what happens to your own portfolio. If this is your style, I guess sooner or later you will realize whether it works or does not work. If you are a professional trader, you are a savvy investor, and you only need to execute at the at a competitive commission rate or brokerage rate, so then it serves this also serves the purpose. What we have seen as a trend in the country about the discount brokers is that the way they position themselves as an electronic platform available, very seamlessly, great front ends, very convenient to trade. It has become very popular even amongst young traders, right? Young service class, 29-year-old, 33-year-old, because we are all coming into a new set of people and traders coming into the market, right? They are different than me. They are different than my father. Right? We always wanted to chat, we always wanted to discuss, and that is how we wanted to invest. But today's 23-year-old or 29-year-old is so comfortable with technology, is so comfortable about identifying how to handle money, that this could actually be a trend which will go on for a long time.
Thank you so much, sir. Thank you so much, sir. And I believe the point here is quite referred here is that before you make a call, because you have to make judgments at 2 or 3 different levels. Firstly, you have to decide which product line you need to get. Then you have to decide which platform you want to use. Thirdly, it depends on what knowledge level of understanding you're going to execute that. If you are a self-trader or a self-decider or an astute investor, then obviously you will go for platforms which are discount brokers, so on and so forth. But if you need guidance or something else, you need to have a advisory type of relationship or a more institutional sort of relationship where you have certain checks and balances, and obviously you have certain backups with you so that you can reach out and speak out to someone to have better understanding and execution capabilities with all those due parlance taken care of. Thank you, Mr. Vineet sir, for this quite, and it was very clear, precise, and to the point. And I think that will go down well with all the investors who are currently viewing us, and obviously in the future who will be listening to you. Next, I would like Miss Lakshmi Iyer to come on board. And now we have seen that how the people have jumped into the bandwagon of stock investing, and many lakhs and millions of new accounts had been opened in the stock trading market in these COVID times, when the unemployment was all-time high. People were working from home, and they were using this opportunity to obviously make some bucks and obviously try their hands on the stock trading, and obviously it added new customers on to the equity segment. Now, equally, there was another end of the spectrum. There were those people who actually were risk averse. The people who wanted to lower their risk. The people who wanted to assure returns. And they were ones who were actually investing into fixed deposits or were invested into the debt funds. But as COVID came, we saw that Franklin Templeton fund getting collapsed when they told that they are winding up, so on and so forth. Long-term gilt funds in, I believe, September and October last year were as high as giving yield of around 10 to 12%, which now obviously have come down. Fixed income funds, debt rate funds have come down. So And also what Dr. Ravi Sauta said, that ki hum conservative hai, we are a conservative investor, and all those conservative investors who are not necessarily from the medical fraternity but otherwise also look at a fixed income portfolio. Now I would just ask Ms. Lakshmi, and I would like her to provide a guiding light how an investor or a person who is retiring, say in next 3 years, or who are already retirees and have their corpus, should have their fixed income portfolio structured like that. I know that she can't make a specific recommendations, but yes, a general understanding is what we expect. She put a light on. Hello, ma'am.
Hi, Rajat, and thanks for this. When it comes to fixed income, there is definitely, or there is no doubt that in terms of volatility, obviously it scores higher compared to equities, because the general tendency is that when you have risk appetite, the leaning towards equity is higher, and vice versa. So it could be related to cash flows, it could be related to what your goal setting, etc. is, which is why we lay a lot of stress on financial planning as to how you need to have your milestones planned, and according to that, you need to have fixed income or equities. Now, on your specific point, when somebody is planning for retirement, the needs are very, very different, because when you are planning for retirement, the assumption is that you have a steady stream of cash flows, and that cash flows can be routed towards the potentially wealth creating asset classes like equity, and the wealth stabilization asset classes like fixed income. So I colloquially call wealth creation asset classes like the Red Bull of your portfolio. They give you a lot of kicker because they have caffeine, and the wealth stability is actually the nimbu pani. So nimbu pani आप सर्दी में भी पी सकते हो, गर्मी में पी सकते हो, and it's completely all weather. So fixed income actually assumes that role. So it's not just that when you're planning for your retirement you have it. There the assumption is that a lesser proportion is deployed into fixed income. But once you have that kitty and you actually have retired, and you have this corpus which is available to you, say lump sum, somebody got gratuity, somebody got pension, and so on lying, and you have the priority changes. So the preference of preserving or stabilizing that wealth earns a higher significance. In that, what you therefore need to do is try go towards those strategies which are neither very high on duration or very high on credit. So I think it has to be more towards the short-term, low-duration kind of strategies. Additionally, we do encounter investors who come to us and say that, yes, I know we are retired, but I don't need money for the next 5, 7, 10 years. I'm good with this. So I'm okay to take on some moderate risk on the portfolio. So, so those set of investors can also do well with these debt equity plans. Erstwhile they used to be called monthly income plans, but there was an assumption that monthly income means you get an assured dividend. Now, one thing is very clear, the only thing fixed about fixed income is its unfixed nature. So it cannot assure you returns. It has to perform in line with the underlying. So I think, therefore, for those kind of investors, there is definitely a worthy look at the debt equity plans. Now, these debt equity plans have a significant proportion of their money in debt, and tail-ended, 15 से 25 रुपए के आसपास, they do invest in equities. So these are the kind of strategies which will give you a nice balance to your portfolio. But yes, as you rightly said, there is no one size fits all. But these are some of the strategies which investors certainly can look at. Alluding to just one more point, Rajat, and Dr. Sauta did make a mention of this earlier. I will just blend the two, his need and someone who was retired, but who is very active in everything else. So somebody take a premature retirement or voluntary retirement, and they're busy in social work, they're busy in so many other activities, they're following their passion. So for such investors, there are options called balance advantage funds. These are relatively newer categories within mutual funds, where the tagline actually is it's automatic. When you say it's automatic, it actually toggles between debt and equity allocation on its own, basis a model, basis a fund manager. So what happens when people like you invest? you are outsourcing your headache of toggling between debt and equity to that particular scheme or that particular fund. And these strategies have played out wonderfully well. If you see the track record last 1 year, 2 year, 3 years, they've played out wonderfully well in terms of equity allocation. So I think these are some of the strategies which one could certainly look at. And if you are not a DIY or a do-it-yourself investor, please consult your advisor.
Great. Thank you, Lakshmi. And now I have also, there are certain points that always we had received over the past 1 week, and that had been specific to it. We have seen Franklin Templeton case happening. What happened to Franklin Templeton funds? They were obviously the 5-star rated funds, and they had been into the industry for the last 5 years, 10 years, 15 years. So they were not something that suddenly came and suddenly got this. So we are not, we are not here as an investor. I'm not referring to what Franklin did wrong or what it didn't do right. What I'm referring to it as a normal investor, if he's seeing a debt portfolio, how he should, okay, he's having a financial advisor, he could guide on it. Many times the rating agencies did not do their job well, so that doesn't transpire into the reports, so on and so forth. But currently, if he has to, if a self-choosing client or an investor wants to make a selection, I should not fall for this Franklin Fiasco again. So what one check he can do, simple thing, which could be, okay, which can at least reduce his risk of getting stuck by say 50%.
See, one thing is for sure, if you are driving on the road, you have to be mentally prepared that there could be an accident. Well, as a fantastic driver, you can, keep your nuts and bolts and checks in place. You can have all your airbags in place, all those accessories to ensure that the impact will be very minimalistic. So I think that is the first and most important rule, that even in fixed income investing, there are 2 key types of risk. There is a liquidity risk, but largely through open-ended mutual funds, that risk is mitigated. But there are 2 key risks which still remain. One is a duration risk. Second is a credit risk. Duration risk is when you are sitting on a very long duration, like 5 years, 6 years, 7 years, and suddenly there has been a depreciation in the price of that particular bond, or the yield has gone up. And therefore, the portfolio is sitting in mark-to-market losses. Now, mind you, interest rate-led volatility losses are not permanent losses, but credit-led. So if there is a 100 rupee portfolio, out of which 2 rupees was in an instrument, which the issuer at the end of that 1 year or 2 years just does not give you your money back, and we've seen such many cases in the last 3 to 4 years, that is a permanent loss. So how do you try quarantine your portfolio against such risk? So first and foremost, understand your own risk appetite. It is like investing in large cap versus mid caps and small caps in equities. If you are a seasoned investor, you're very happy going into mid cap, small cap, knowing that the volatility is higher, the risk reward is higher, but jhatka lagta hai to zor ka jhatka zor se. The large cap tendency typically is zor ka jhatka dheere se. So I think between the 2 risks, credit risk is zor ka jhatka zor se, interest rate risk is फिर भी जोर का झटका धीरे से. So I think this is the most important thing that the investor needs to keep in mind. And secondly, try to keep away from excessively concentrated portfolios. I think that's also very important. So yes, you do have a regulatory, cap of 10% per issuer in the portfolio. So very theoretically, I can run a 10 stock portfolio. But when you run a 10 stock portfolio in small cap versus a 10 stock portfolio in large cap, can you see the difference? The difference is liquidity, the difference is risk perception. Similar is running a 10 stock government security portfolio versus running a 10 stock or a 12 stock, 15 stock non-AAA portfolio. So I think these are some of the risks. It's not as simple, which can be explained, in the course of next 5-10 minutes. But these are the broad preamble, or I would say skeletal framework that the investor, especially, as I said, and I keep telling this to everyone, I'm sharing this with all of you and the audience, that for everything else, for all your Gyanbazi, there is Google. But please, for your investments, don't try to wear the Google buddhi, because ultimately what happens is Google gives you one-size-fits-all approach. But there are many nuances which one needs to check the box. And therefore, a Sarathi or your advisor is very, very important.
So what you actually, thank you so much, Lakshmi. And this brings on to the one crucial point. It was 2008. The crisis were just going to begin, and I was at the bank. So I was just a new joinee. I was a personal banker at HDFC Bank. So मैं बैठा था, and there was a client who just walked in. So obviously, I was a sales guy. I had to pitch a fund. Okay, sir, HDFC top 200. ये वो ये. He just came. कहते यार, come on, यार, cut the crap. You come over to my home. We'll have drinks together. Now, I went to his home. I had drinks with him. Rajat, 15% तो मैं खुद कमा लेता हूँ. 15 to 18% I make myself. You tell me how much you over and above would be able to give it to me. So that was, and it was just, and after 1.5 months, we saw like a market tanking down. So when market went how high today, those who were actually entering for the first time, they were on the same gung-ho, a bit of it. But yes, they were the larger chunk whose money actually had been impacted badly. And they had their lessons also. They had their lessons also. And one point that Lakshmi rightly quoted, normally what happens, on the interest rate spectrum, if the interest rates are going down or going up, rather than selling on and off, it is good to wait and get, because if we hold fund to its maturity, yield to maturity will remain for that duration if we hold that fund to the duration. Thank you so much. And I think you have given more than 3 golden rules in your session. And thank you so much. And on the fixed income portfolio, is actually...
Rajat,
Yes,
can
sir.
come in because we are looking at Dr. Ravi Sauta as the
Yes, sir.
audience who's posing question to this panel. I think it is important that each one of us do not duck the question that he asked all of us, which was what
Yes,
are
sir.
the 3 principles, because otherwise he should not be left high and dry after the panel discussion. So I wanted to add from my side what
sir.
are the principles that he or others who are listening to this particular session could keep in mind. And I am trying to use the same parlance and same language which has become so popular in the last 9-12 months, which is COVID. And in any case, your session is about investing in the post-COVID era. So the first important principle, sir, that I think any one of us should keep in mind is the emergency fund. It is like our N95 mask, which you cannot do without. So each one of us who is faced with the uncertainty of a business decline or a job, unemployment, should identify what is that minimum amount that I should keep aside before I even think of investing in the market. So whether it's a 6 month of monthly expenses or 12 month of monthly expenses, please identify that. The second one, which is taking, from long-term investment or medium to long-term type of approach, is portfolio distancing. Very much like our social distancing. Try not to look at the price of the mutual funds in terms of the NAVs or the stocks in your portfolio every day, every hour. It is noise. It will distract you, and you will always be in that emotional roller coaster, which is going to make you take wrong decisions. To step away, construction of the portfolio is important, right? Which I will come on the next step. But once you have constructed it, review it, but just don't keep reviewing it every day. So portfolio distancing is the second principle I would like to share in today's session. The third is hygiene and sanitization. So portfolio sanitization. The portfolio sanitization is something that I want to borrow from Lakshmi's suggestion, which is about, concentration, well diversified, keep track of what you included in your portfolio. Is it still holding true? Has the rating of your bond gone from AAA to AA minus, and therefore the time has come to sanitize it? Stocks have become Z group, B1, B2, whatever it is. So sanitize your portfolio from time to time. Keep track of, the concentration risk so that it will hold you good over a medium to long term. And the last one, which is the bonus, you wanted 3, I'm giving you 4. The fourth one is boost your emotional immunity. Just the same way that we have been hearing about boosting our immunity in the last 9 to 12 months, much is lost or damaged because of our emotional and irrational thinking. And irrational thinking as an investor comes not only the market is tanking. It also comes when the market is rising. So
Exactly.
careful about that stress due to euphoria and panic. These are my 4 mantras for you, sir, today.
Thank you so much, sir. And I think, yeah.
Thank you so much.
You're most welcome.
So great, sir. Very, very, very well. And to the point, it has summed up many critical things at the strategic level, because unless and until the macro structure is not kept right, obviously whatever we do, we normally go product wise. हम product के ऊपर घूमते हैं, but we don't fit that product in our whole life structure or our own financial goals. Thank you so much, sir. And now we are coming on to the alternative asset class for which zamindari, if I would say, in Bollywood style. So we are now coming on to the real estate, and we are very happy to have Ms. Khairul Shah, President, World Trade Center India, with us. Welcome, ma'am.
Thank you so much, Rajat. But before that, Vineet, you actually linked the COVID-19 and the post-COVID-19 with the mantras. I simply loved it. I must say that.
Thank you very much.
I was not aware. Kalpesh didn't tell me that he had been such a great. I would say he actually took very great a moderator task. The burden on my shoulders have eased a lot. I would rather have him taken over the lead, I would have. Frankly speaking, it's been really nice, and I think the main lacuna, the gap that was in this conversation as it is going, and actually Mr. Bhatnagar has fit it well, and I believe that we have many viewers live with us, and they would actually would be in sync with what Mr. Bhatnagar has said. So coming on to you, ma'am, and how has been this COVID journey for real estate sector? So if we may hear from the horse mouth.
I mean, everybody knows that COVID-19 did affect real estate in a major way. And those people or those organizations who kept pace with the times, I mean, changed to technology and made use of technology, were fast and innovative and were up on their feet with innovation, have been doing well. I mean, real estate, and when I'm saying that have been on their feet, what I mean is that they have diversified their portfolio. Real estate is a cycle. Sometimes we have an asset class of residential, which is peaking, and at other times we have commercial real estate, which is peaking, or the sub-assets of the commercial, which are peaking. So it's a cycle, and that is what we see, that that those who have a diversified portfolio, have a wider range of portfolio, and in different markets, they have been doing well.
Great,
so it's a mixed bag.
Great, ma'am. If now from the investor psyche point of view, if I may say, and let's understand how the real estate market has been impacted and how the clients have been impacted, and now how clients should actually approach it. So we know that once the lockdown was there, construction activity was stopped, the people had lost their jobs. So obviously the payments for the real estate sector, the payments had stopped, loan moratoriums had been there, defaults had been there, because obviously the wheel had actually stopped rolling. Now, from the sector itself, how you see from, say, I would say in August 2020 and now, what changes you have seen in a sector in terms of getting the projects on track? Yeah, how it has been then and now?
Rajat, let me tell you that the commercial real estate, it actually offers investors a powerful way to protect and grow their wealth. Depending upon the strategy, the commercial real estate can either act as a cornerstone or as a diversifier within the asset allocation. So that makes it very important. So what is important for the commercial real estate is the diversification, the tangible asset, the advantage of being a tangible asset, providing a steady cash flow, a higher yield, lower maintenance and investment for the owner, and inflation protector. Real estate has always been an inflation protector, especially when it is the commercial real estate. pre-COVID, I mean, or let's say post-COVID, August onwards, the last quarter of 2020, we saw a great momentum building up. We saw corporates, earlier they were reeling during the COVID times, they were reeling between whether there is going to be a demand for office space, whether there is going to be, what is going to happen to our sub-assets like co-living, what is going to happen to the sub-asset of co-working. So I mean, there were different thoughts, but August onwards, we realized that there is an untapped potential in the Indian market. The yield that we have been seeing in the commercial real estate is it's a very wide yield, ranging from 7% to even 14%. I mean, if you look at office space, if you look at co-living, co-work spaces, if you look at warehouses, if you look at data centers, the range is between 7 to 14%, which is a pretty good yield that one would see in a commercial real estate. And when we are looking at co-living, again, it actually is acting as a commercial between 7 to 11% yield, as against a residential asset, which actually gives you a yield between 1 to 3% or a national average of 3%. So we have seen, in fact, you will be surprised that during lockdown, when we were talking about when we were talking about Gift City, we signed up 22 leases. 120 lakh square feet was signed up during lockdown and operational in Gift City. So 22 companies are already operational in World Trade Center Gift City. So there is a huge demand and a greater yield which real estate is offering. But yes, the sentiments earlier were that real estate would go down, there would not be demand. We have seen a lot of demand for data centers coming up. We have seen a lot of manufacturing in industrial parks coming up because of the government initiatives of Make in India and Atmanirbhar. We are actually seeing a huge demand for industrial parks also coming.
And one more thing, if I'm not wrong, quite recently, around I believe 2 or 3 days back, there has been also a decision taken by Government of India where they are now incentivizing the production on a larger scale, whereby those companies like USB cables, like plugs, even those productions are getting incentivized. If they get incentivized, that will actually spur the demand of many companies shifting obviously from China to India, and otherwise also, though obviously will create a demand.
Largely, we have seen that in electronics. Yes, when you're talking about chargers and the mobile accessories, India has been a great market, both in terms of the demand and the consumption. What we are anticipating is that India is a great consumer market, and by 2030 itself, it's going to be the 5th largest consumer market. Keeping that in mind, there have been a lot of consumer or FMCG companies which have been looking at India. With the incentives that are being given by the government under the Make in India, Atmanirbhar schemes and various smart city schemes, various schemes which the government is providing for encouraging investment from outside, as well as investment within India itself, so that we can build up Indian champions. There is a lot of scope. World Trade Center Noida in itself has been one of the major catalysts in building up an electronic city in UP, and a mobile center, a MOX, which has also been inaugurated by the Prime Minister. And it is a part of the ESDM industry, which is attributed to be a $1 trillion industry. So there are companies, even Indian companies, which are getting under the PLI scheme, they are getting a lot of opportunities, tax benefits, the production linked incentives and schemes, which the Indian companies can also avail.
And also one more thing, like one point you already said that which was quite relevant when we say about the diversification of the property. So like Mr. Bhatnagar also said, when we are structuring the portfolio, we have to keep emergency cash. And you also said that there has been a proper asset allocation in the property. Apparently, what we have seen in Indian investor landscape is that we have the money and we get it pumped into the property, obviously without seeing, okay, what is the return we are getting. So majority of the Indian investors like cycle, yeah, like you rightly said, it started with real estate. It went on to the commercial. Now it is in data warehousing. Then it is co-living and the co-workspaces, so on and so forth. So the curve is going like this. Now, if I'm not wrong, correct me, ma'am. In co-living and co-workspaces, the unit size comes very lower also. So rather than an investor having one single property of 1 crore each, he could have the smaller commercial properties of say 30 lakhs, 25 lakhs, even 15 lakhs, 20 lakhs for that matter, and he could have it diversified. So he's not actually breaking the bank, but he's able to diversify. I believe that that is the way how it's with WTC also.
See, yes, what you're basically talking about, what we have done at WTC is we are offering a very diverse portfolio, not only in terms of the product or the asset, whether it is co-living, whether it is co-working, whether it is commercial, whether it is a data center or a warehouse or an industrial. But what we are also doing is in terms of the whether it is a lockable area or an unlockable area, whether you would be you would get a tangible asset or you would get just a non-tangible asset, but a real estate asset. The difference largely is in terms of whether you would want to have the headache of maintaining that property, the maintenance and to do the property management. We have a very, very diverse investors in India, and we wanted to cater to them. So what we did to cater to them, we actually created a product which was to, if they wanted to manage their property, we had a different property asset for them. If they did not want the headache of managing their property, did not want the maintenance issues with them, so we created a non-lockable asset for them. And this is not only true for us, but this is what largely how we see the commercial real estate actually now moving towards in India, especially now that when we are talking about REIT, and we already have had 3 REITs already there. So this is the way forward for India now.
Great. And like you rightly said about the safety security, so I would now like you to take on Dr. Ravi Sauta in terms of your 3 takeaways. And I believe he's one of the best investors you could have always anytime have it. So I think what are the 3 golden rules you would like to say to him, Dr. Sauta?
I will tell you. In fact, I was actually thinking about the mantras that just like Vineet said, but my mantras are very simple. Invest with a brand, a reputed developer who has a wide, diverse real estate portfolio. That's one. Invest in a diverse portfolio of CRE, which offers an easy exit. And an exit should not be, within 2 months or 3 months, but hold your investment, a minimum 2 years, hold your investment. So that's the third mantra, I would say, not less than 2 years. The minimum that you should be looking at is 2 years. This will ensure 4 things for you. One is a security of investment. Second is a capital appreciation. Third is a return on investment. And fourth, because you're investing with a brand, a pride of ownership. So invest, and hold.
Also, you mean to say when you invest in a WTC investments, so if it is a non-tangible, do you spread it out into different institutions of yours? Like, for example, some in Noida, somewhere in Chandigarh, somewhere at the same time? Or what do you mean by diversification?
See, Dr. Ravi, see, right now we are not a REIT project, okay, but we are planning our own REIT. At that time, we have 13 World Trade Centers, which are going to be a part of that REIT. So any investor who would want to invest in WTC would get a choice to invest in either of the WTC's assets. But currently, the compliances are such that if I am actually taking out, when you are investing in, say, WTC Noida, then I have to offer you a product in WTC Noida. I will give you a choice whether to have a tangible asset in WTC Noida or a non-tangible. The option, the difference, like I said, is you could have a physical possession of that asset. You know, we call that allocable assets, and we have minimum areas of 200 square feet going up to a million square feet, if that is what you would want. But as far as a non-lockable is concerned, our minimum area is 500 square feet of investment, or multiples of 500 square feet. So you do not have the problem, or I mean, you do not have to worry about leasing that area, getting a tenant for that area. That are all concerns which are taken over by WTC, and all the rentals or the yield that you would be getting from leasing out or from that particular asset, that would be proportionately shared with all the investors which are there. So it acts like a REIT, but it is not actually a REIT in a proper technical way.
So if I may patch these things together, it's like an automated mode. Just like Dr. Sauta in the beginning had reiterated, we want something to be in automated mode because we don't have time. So if we have ETFs, exchange traded funds, in mutual funds, or then you want to go one step ahead with fund manager driven funds. So like you have a balance advantage fund that automatically take care of your things, that like Ms. Lakshmi Iyer had told. Accordingly, in real estate, like Ola and Uber, you are not going to have your own car or OYO rooms. You just go and do it. So similarly, in real estate, you can still have investments in property. So first, you can go for a smaller sizes, maybe in multiple cities, and that too in which the ownership, leasing, renting, collection, distribution happens automatically. So you don't have to run between the brokers on way. Obviously, you can diversify between cities, between geographies, or even between countries. So you can have your one asset class in, say, Dubai. Dubai prices are also quite down for that matter. Thank you so much, Ms. Khair, for quite this debriefing on it. And this now brings us to the critical element, which is called as the global investing. And we have Mr. Hon Meng from iFast Financial on the panel for it. He's from Singapore. Welcome, sir.
Hello, everyone.
Hi.
Hello, sir.
Yes, do you have a question for me?
Yes, yeah. So normally what has happened, like when we have seen in the month of September last year, or when in India, or 1.5 years back, when the IIFL fiasco had happened or DHFL fiasco had happened, at that time, Indian markets were subdued. Indian funds were down. But when a normal investor was actually looking at a scheme of funds, he would see, okay, these are global funds which are positive. So Indian large caps were giving, say, 2% return, 3% return, but frankly, India, US Opportunities Fund, or you can say Mirae Asset Global Fund, Consumer Funds, or a China Fund was actually giving around 22% returns. Then we got a query from the clients. They were saying, okay, one is thematic funds, one are fund of funds. So these Franklin Fund or say any of these ICICI US Global Fund or something like that, we invest in Indian funds, they invest overseas. And with Elon Musk coming with Tesla and everything, now investors' query has come to a certain level. Investors now want to invest globally, and they want to have it as seamless without any new learning to be done. So plug and play. So from global investing, and since you yourself has been instrumental founding iFast Financial, a fintech company, I would like you to start a conversation on how the global investing can be done, what is it there for Indians, and how iFast has been in this space, and how the whole space has transformed from early 2000 to now.
Okay, wow, that's quite a bit there. I think the main thing is to be convinced about investing globally. I think for most investors around the world, they have this thing called home bias. They essentially have the most or all of their money in the securities of their local market, but that's actually not a healthy thing to do. If I might share a story, I've started going to India about 15 years ago, and when my first time there, I landed in the old Mumbai airport, and then I stayed at the Taj, and then I tried taking an Indian taxi at that time, and I found I couldn't communicate with the driver, and then and I saw that the taxi was made in India, and then I had to call an Indian transport company that in order to fetch me around. So it was I tried to go to a mall, but there wasn't one. So the closest they brought me was this dusty Indian market. There was a hive of activity, very exciting. So everything was Indian. Everything that I consumed in India was Indian. So if you fast forward to now when I go to India, I stay at the Hilton. I get around through an Uber, and when I get into an Uber, it's either a Suzuki or a Hyundai. And on the roads, I see Toyota and Mercedes. I go to a mall near our office, and then I drink coffee at Starbucks, and I see everybody around me. I think clearly the middle class, wearing Nikes and Levi's. So the thing is, if you think another 15 years into the future, if you imagine a future where there are more and more people in India becoming middle class, and you think about what they would consume, and I think that they would start to not buy the local Indian stuff and start to consume a lot more of the imported things. So it's actually a new reality. That the world is globalizing, and all of these global giants are dominating the world, right? It's not just the Facebook, Google, but it's also the Visa, MasterCard, it's the Nike, McDonald's.
And
So
I
these
also
are,
see it's if we see it from the cycle of investments also, we also see it as an aspirational level. Like an Indian investor and mutual fund investor would like to have access to global markets, say buying a Tesla stock or having funds which are listed at, say, for example, here, London.
yeah, so it's not so much their aspiration to own a foreign stock, right? I think my point is more that these global stocks are such giants that they are catering to the entire world. That it doesn't matter whether you're in India or in Indonesia or Brazil, you're all using a Visa, you're drinking at Starbucks, you're wearing a Nike, and you're on Facebook and you're using Google. So these are global giants, and they're taking market share and earnings away from the local players. A very clear example would be the media companies. Whether it's an Indian newspaper or an owner of another advertising medium, they would find that their incomes have dropped a lot because a lot of the clients are now advertising mostly on Facebook or Google or YouTube. So these are American companies, and they are vacuuming up all the advertising dollars and threatening the local media businesses. So over time, far into the future, India really has to think about what are the kinds of things that India can make better than everybody else in the world and supply to the world. So Indian companies need to be global as well. So in this globalized world, then it becomes quite dangerous for your personal portfolio to only hold Indian securities. You have to think about holding these global companies that are supplying to the whole world.
I think you made a very critical point because, yeah. Now, what do we say that you actually made a very critical point. You actually made a very critical point because normally what happens as an investor, what we do, we say, okay, we want to buy a Tesla stock, or we want to invest in a fund which is listed in US or a NASDAQ. But what point you actually said, because and obviously under current leadership, the India is among the growing marketing hub and so on and so forth. But you made a very critical point. If Indian companies grow and have their operations spread into different overseas jurisdiction, then obviously they are selling their services, they are getting money from overseas into India. In that case, Indians would like to prefer holding on to the Indian funds or Indian stocks, then obviously their wealth also increases, so on and so forth. So I think that is a very valid point you said. So if by the time that happens, and if, say for example, if some investor comes, we know that from an investor portfolio, we know that there is a uh, India as a geography entity, as a currency entity, or a news. If there's a political uncertainty, we can understand that the Indian stock markets or the fund would be less. Now, if there is an investor who says, okay, I have a part of the kitty inside, I also want to have a part of the portfolio outside. How can platform assist him or enable him to take that leap? And how does iFast enable that? If I may put that as a real life example to quote.
Okay, so because of this increased interest in investing overseas, you'll find that many asset management companies in India are launching more and more funds that allow them to invest overseas. So that would be the easiest route to take. A lot of these are feeder funds, which feed into some other fund that mostly now they're based out of Europe. So there's an additional layer of fees, but it's not a lot. But that would be the simplest way for a lot of Indian investors to invest overseas. A lot of these mutual funds are available through your mutual fund distributors or through your bank. Or if you like to take a bigger step, then it would be actually to open an account directly with a foreign broker. So if you open an account with us in Singapore, the website is fsm1.com. You have to indicate where your nationality, and then there will be instructions on how the kind of documents you need to submit. And then there's the liberalized remittance scheme, the LRS, where you can remit up to 250,000 US dollars overseas per person in your family. So if you have 4 people in a family, you can remit $1 million US dollars and invest that overseas. So that those and I think that I do see foreign brokers advertising in India. So so I'm sure there are various ways that you can open accounts with them and transact with them as well.
Okay, I believe, and I totally agree to you. And I think as an investor also who has obviously sufficient capital base, we can't talk about the middle class people, because then obviously the risks that come along with it, whether it is currency fluctuations and otherwise, that also do come in. So I think then there's one thing that still I believe Mr. Bhatnagar would also be able to put light on this, because Phillip Capital also provides global services in the stock broking. And I believe, if I'm not wrong, sir, I would request you to correct me. What we had come through information knowledge is that we can have a demat trading account, or we can have a platform like iFast in Singapore or overseas. And from there, we can have access to 35 stock exchanges or a 16 stock exchanges or different jurisdiction, different funds, whether ADRs, GDRs, and so on and so forth. But in India, we can't have this global platform, because in India, I believe there are some SEBI restrictions. If I'm not wrong, I had come across an article where in Sri Lanka, you can set up a global account and you can invest in different funds. So how is it? Say if an Indian investor wants to be in India mein baith ke kahin karu, how it is? So Mr. Bhatnagar, I would like a bit of inputs from you on this.
So there are a couple of ways in which the objective of taking an exposure to international markets or international instruments can be achieved. One, which is the simplest, is that the Indian asset management companies themselves are offering products which are investing abroad. So as an institution, SEBI had given the permission to an Indian mutual fund to come up with schemes which can invest abroad, right? So whether it is a DSP product, it is a SBI product, so Invesco product. So there are schemes in India, which are investing in international markets, and there are some of these funds are doing very well, and they have been around for quite many years. So there is nothing to do about opening a separate account, global account, currency risk. You invest in Indian rupees, your institutional fund manager is investing on your behalf, right? So that's one way to do it.
I think that I think then if we, because if we are just like connecting the dots and we look at, so I will see that if there is one set of customers who are say NRIs and affluent investors, and have been, obviously their part of the portfolio is in India and a part of the portfolio is overseas, and since the nature of job these years is such that they keep on moving around the world, and for them what they will be doing is key, they would have a part of a single centralized global portfolio, which may be their overseas holdings. So if somebody is working as an investment banker or as a technocrat based out of say London, and tomorrow he switches or shifts to Hong Kong or to a US, he can't keep on moving his portfolio. So if we say that, if we, from Indian investor parlance, if he's an NRI, so we can, this my assessment, and you may correct me, he could have a two part of the portfolio. One, obviously being in India, if there is an Indian retail investor or an HNI investor who has no connections with overseas, he could have a part of investments in the global funds, because obviously that would be an automated, managed by institutions, managed by funds, well diversified, currency risk taken into consideration. So too many frills are not to be taken care of. So it becomes much of an automated mode. For those people who are already in an NRI and have their portfolio overseas, so what they can have a single centralized repository where they can manage their accounts in 6 different currencies across the world.
So
And
so so you are asking the right question, in the sense that so there are NRIs, right, who have interest in investing in India, and also have the ability and flexibility to invest abroad, right? So they could be in Singapore or they could be in New York. Now, when such NRIs are constructing their portfolios, and their objective is to get exposure to both markets, local and global, they can very well do this either on an iFast platform or a Philip platform or any other bank that they may be a customer of, to put together portfolios which is made up of funds which are global and funds which are also Indian. So if you go abroad, you will obviously come across an Aberdeen fund which is investing in India. You will come across a Goldman or a Fidelity fund or a Schroeder fund which is investing in India. Similarly, you have a Fidelity fund which is investing in US biotech. So as an NRI, actually your choices are, unlimited, and your structure of investing is very simple, because through one single investment account, you can do both. The third thing that I want to talk about is what Mr. Meng was also talking about. A resident Indian trying to invest abroad, right? And not through these Indian mutual fund which invest abroad. He wants to do on his own, right? So he can do two things. He can do, because there is an RBI guideline. So there is a framework that is available, which is $250,000 per year, per financial year, that an investor, resident individual investor, can invest in international markets, but without leverage. It should not be a leverage. There should be no borrowing. There should be no margining. It has to be one-to-one, right? So you can invest either on stocks or you can invest in funds, right?
True.
Our advice is not to become adventurous. And coming to Dr. Ravi's, point that he had made, there is no time or no capability for many Indian residents to actually understand what to buy, when to sell. So in such case, the best thing is to go to a platform, right, where funds are available, right? Mutual funds I'm talking about, or ETFs that I'm talking about, and invest in such funds or ETFs which are investing in global markets. So that's it just takes care of the LRS type of customers or investors.
Great, sir. Great, sir. I think you have made a very valid point here. And now we are so here we have seen how whether it's stock trading, mutual funds, global funds, the main notion is, if I would tell each and every investor who has been viewing this or will see it in the future, there is one underlying point. There is one underlying point, if we are seeing, that is, don't be an adventurous. Keep is as much automated as possible. There are specialists who are actually managing the things, and have a very simplistic look as far as your portfolio is concerned. So that is how it is. So now there are a couple of questions I will be just asking it before we will be wrapping up the same. And I believe some of the very good questions have come up. So one of the questions had asked, ki, now the SEBI has come with a gilt bonds. Ki investors can directly invest in gilts. I believe there was a time. So I would ask Ms. Lakshmi, so what an investor should do? Just because it is a gilt fund coming from the government and it is backed by the government, should they jump in, or what they should do?
So, Rajat, gilt mutual funds which invest purely into gilt, which is therefore only sovereign risk. So there's only interest rate risk, have been in existence for over 2 decades. Yet the AUMs are very, very, I would say, at its deplorable condition, very, very poor participation from retail investors. It's a very great initiative that the central banker has done to allow retail investors like you and me to participate directly with them into the gilts. Very important to note for all the viewers is that, yes, gilt fund obviously means sovereign risk, so there's no credit risk as such, but the risk of interest rate fluctuation still remains. So keep that in mind. Second is, if you are largely a fill it, shut it, forget it investor who is okay to compromise on liquidity, because we don't know how the liquidity will evolve for smaller lots. Today, the wholesale market, which money managers like us trade, are in lots of usually 5 crores ticket size of little under $1 million and beyond. So that's the market size, and there the market is extremely, extremely liquid. So I think it's a good initiative. It's a good add-on you can have to your portfolio. But as I said, don't assume because you have direct access, you're done with volatility. That's not true. So we live in the real world, not in the real world. So I think.
So I would like to say that. So if I would say you don't have to propose a girl, the first girl that comes out of the college. So you can at least wait a couple of times and then let a couple of buses let pass and then see which one. Have a choice before you jump in, because once you jump in and that to get married, there is obviously no way getting out of it. So so I
then
think
you can't say Rajat, in your analogy, then you can't say MBA, married but available. You can't do that.
I agree. I 100% agree to it. And one last question, Dr. R. Kumar has asked a very simple question, and I think that is a question of all 90% of the people. And he has simply asked, I'll just carry his word just a second. He has simply asked, what is the take-home message for senior citizens so that they have good returns and safety of capital? What is one thing that you would, and and any one of you can jump in. Very simple question for senior citizens. What is your message? What is message? Safety of capital and okay returns.
No, so Rajat, my answer to that is good is very, though it is in the positive, there's good, better and best, but it's still a very relative concept because beauty lies in the eye of the beholder. For you, good returns might be something which outperforms a bank fixed deposit. For me, a good return is not just bank FD plus, but which is bank FD plus inflation plus. So, it's a very, very relative yardstick. But I think one thing which retired, investors need to keep in mind is, yes, it has to be return of capital than return on capital. So I think keep that in mind as an overarching principle when you are planning your investments.
From my side, I'll just give you a data point, Rajat, and Mr. R. Kumar may want to keep this in mind. The 25-year CAGR return of SENSEX from 1995 to about 2020 is about 9.2% only, right? So a very passive investor in a index fund or an index-driven ETF could have hoped to get something like that. If you are doing actively, by actively, I don't mean that you are changing your portfolio every day, but you have taken help of a of a professional who has constructed the portfolio for you, well balanced, etc., you can hope to get something like 10.5 to 11%. Let's not aim for high, because there is no free lunch in this particular, in financial markets. There is nobody who has been able to make consistently high returns without contracting high risk. A point that Lakshmi also brought out. You need to understand yourself what your appetite is. But as the question is asked with reference to the senior citizens, I think that the risk appetite is lower. Capital preservation is important. Therefore, aim for 10 to 10.5%. This is based on the last 25 years. What the next 25 years have in store for all of us is a different matter. But every passing year, you can keep a track of the CAGR. What I also want to share with senior citizens, please do not fall for the trap of the flavor of the month story or the flavor of the quarter story. Do not fall for those advice that are coming about the small cap and mid cap. I can share with you as a data that if you invest your money in high quality stocks, you will always be better off. In 2008, during the Lehman crisis, when all markets tanked and so did the Indian markets, the top companies in India took just about 4 months to come back after the crash. The index, on the other hand, took 20 months.
Wow.
Right? So keep this simple, keep it less greedy. Do not listen to too many advices that are coming around doubling of the money, tripling of the money, 40% return. Stick to the simple strategy of high quality stocks. I must also warn you that there are no permanent best companies. There is a study that was done by and released by Motilal Oswal. They looked at last 25 years and companies which made greatest amount of wealth for investors. The names that were there in 1995 are not the names that are there in 2005, right? So a lot of names which were the darlings of the market were not there in 2010, right? Whether it is SAIL, MTNL, even Tata Motors, Tata Steel, etc. So keep looking at what is high quality over a 5-year period, 10-year period, and construct your strategy or portfolio based on that. If your big principle of sticking to the high quality companies is there, you will never or very unlikely to go wrong. Do not worry about, should I really be buying this at 52-week high? Because what goes wrong is actually buying at the 52-week low, right?
True.
If the companies, if a good quality company is continuously delivering earnings and profitability, there is a compounding effect that could continue to happen even if the price is near the 52-week high. Great example, Nestle. Right?
Exactly.
You've never bought Nestle if you were looking for value investing, right?
Very
great
true.
companies should remain great and could remain great for a long time.
Great. And at this juncture, I would like Mr. Mohan Meng to put his views on it, because you have been involved personally also in the Asian markets and also have seen Indian markets a bit of it. What are your takeaways, if I may ask?
No, so for senior citizens, I mean, it really depends on your investment knowledge as well as your investment horizon, right? So even if you've retired, the question is, how long do you expect to live for? So if you are retired at 58 and you expect to live till 78 or 88, that's still another 20, 30 years. And that's still quite the long term. And you actually can take some risk. So if you know how to plan your portfolio, you have a portion of it in fixed income that generates the income that you need, but you can have a portion of it in in equities because you do have the time. So the other thing we discovered is that for a lot of senior citizens, they are actually more interested in taking risk because they have seen all the market cycles in their lives, and they know that markets crises come and go, but the markets always trend up in the long term. That's only true if you are invested globally. It's very hard to say if you have all your money concentrated in one specific market. But if you're invested globally, let's say something like the MSCI World is giving you over 9% per year over the last 50 years. It always goes up along with global population growth, along with global productivity growth, and the crisis will always disappear. So because the senior citizens have seen all these cycles, they're actually more confident in taking risk, and they actually do have the time to do so, because it's still another 20 years that they have to live for after retirement. So, so don't be too conservative is what I would say. Still have some money in, and if you don't know how to do it properly, please get professional advice in the form of I think what's very exciting in India now is the coming of the Registered Investment Advisor regulations, the RIA. So I think there's some really great RIAs which are independent financial advisors who would stand on your side and give you an objective plan that you can use. Their fees more than worth it if they can create a proper plan for you for your retirement.
Great. Thank you so much, and for giving such an you can say high-powered pitch session, and end to end it has been 2 hours now. We were planning to be for 1.5, but I believe as much as we could have covered it to bring much more value to the investors, we have done that. And I would take this as an opportunity now ask Mr. Dilip Sharma sir, as a Director General for the Federation, to come up with his closing remarks and his pointers, and obviously Dr. Sauta to close from his end. So off to Dilip Sharma ji.
Thank you to all the panelists and people who joined and who watched live today the program. It was a great learning for me also. As I said in the beginning, the finances is not easy for everyone to understand, but the whole team, the panelists made so easy for people who didn't understand the finances to understand how should they be going about the investing. And we said the COVID has changed all our life, impacted our life in many ways, and so is the investing pattern, which is we've seen in the stock market. It went down, and where it is today, it is almost doubled, more than doubled what it was at the lowest in just about 8 to 10 months. And we look forward to the association of the panelists with the Indian Investor Federation in times to come. As I said, this is a non-profit organization which has been built, created for the welfare and to take the interest of the investors forward and create opportunities for them. And look forward to your associations, and thank you once again.
Thank you so much, sir. And Dr. Ravi Sauta, sir, is there something else I would like from the investors' point of view? I would like you to have some last words.
Yeah, Rajat, thank you very much for the opportunity, and it was a very, very special platform, and really I feel that I'll be more confident and feel more safe in future of my investments, because there has been a lot of doubts which have been cleared up, a lot of insight which I learned, how to really be more wise and how to allow you little more freedom to play with the investments of mine and also with others. And it was nice to hear Vineet ji link the COVID thing to the investments and finances. And I learned a little bit about the global global investing from Menk & Co. It was interesting, and it was also interesting to understand from Madam Khairul Shah to understand how the so-called WTC and investment diversification can even work in real estate. So I was not really very much aware about a few points like that. And thank you very much all the panelists to share a platform with you all. And thank you, Rajat. Once again, over to you for final comments.
Thank you so much, and thank you, Mr. Vineet Patnagar, who has joined us from Phillip Capital as a Managing Director, CEO, talking about the trading segment. And we have Mohan Ming from IPOs Financial Global Markets, Chairman and the founder for IPOs Financial. Thank you so much, sir. Dr. Ravi Sauta, representing from the investor community, if I would say, that too from the medical fraternity. Miss Lakshmi Iyer, and thank you so much, ma'am. I know that you have to rush for another call, but being there till the end, thank you so much for all the insightful things that you've given. Mr. Garg, having made time available to us at that crucial juncture when all the investors had been very petrified because of that NSE fiasco. Thank you so much for there and giving us your valuable insight. Thank you so much, sir. Thank you so much, sir. That was really heartening. And at last, I would like to thank Ms. Carolina Shah from World Trade Center. And thank you so much, ma'am. And I thought that you might be on the air right now onto USA before, because the international flights are not there, because I know that you have been traveling between this journey. And thank you so much, ma'am. Thank you. So WTC Chandigarh, I believe. WTC Chandigarh.
Right. I am really honored. It is.
No, ma'am, please drive.
It was a great I am actually, no, thank you. I'm really honored to be on this panel, and I really thank everybody. I really had a wonderful session, really wonderful. Thank you.
Thank you so much, and thank you everybody.
Dr. Ravi, I am very glad that I've been able to show, at least showcase that there is an alternate asset to be invested in, and not only WTC. I mean, most apparently, I would always promote WTC and the portfolios that we offer, and in different locations. But like I said, the most important thing for you is the security of investment, and the capital appreciation. You know, that is the fundamental, I believe, for any investment, and that also goes for real estate.
Thank you so much.
Thank you. Thank you so much.
Thank you so much.
Thank you so much. And I will be just logging off the session. Thank you so much, and have a very great weekend together.
Thank you. Thank you.
Thank you.
Thank you.
Thank you.